the end of financial year again. As an investor, while we're preparing the documents for dividend, capital gains, to lodge the tax return, it's also a great time to review our portfolio to see if the asset allocation or any investment holdings that don't suit our current financial goals. And tax loss harvesting is used as a strategy to minimize the net capital gains, therefore to pay less capital gain tax. In this video, I'll be talking about what is tax loss harvesting and how does it work, and when you can consider to use this strategy. My name's Irene. Now let's get into it. So what is tax loss harvesting? Tax loss harvesting is the selling of securities at a loss to offset any capital gains. As you would make a loss by selling the losers, it's also called tax loss selling. And one thing that we have to be clear that is you can only claim a loss for shares or units that you have realized. We cannot claim any paper loss or investments that we continue to hold. In Australia, depending on whether we made the loss as an investor or share trading under a business, there are different ways to trade the loss in our tax return. I will only talk about how we trade the loss as a share investor, since this will be the most common case. So when we bought high and sold low of shares, for example, the loss is the capital loss. And on our tax return, the capital loss can offset the loss against any capital gains or carry forward any unused losses to offset against future capital gains. And based on ATO, there's no time limit on how long you can carry forward a net capital loss. Although capital gain tax is not a separate tax, and capital loss cannot offset against our income from other sources such as salary or dividend in Australia. I'm going to show you an example of how to quickly calculate the amount of capital gain tax. For example, I plan to sell my CSL shares and A2 milk shares. Firstly, we need to calculate the capital gains by taking the selling price and subtract its original cost, subtract any expenses such as brokerage fees. In this case, I only have capital gains on CSL shares, which would be $667 because my A2 shares gave me a capital loss of $510. So my net capital gain would be $157. For Aussie investors, if you had bought assets on or after 21st of September 1999 and held for at least 12 months, you'll be able to enjoy 50% discount on your net capital gains. So my nominal capital gain for the shares would be $780.50. And last step, I will add my nominal capital gain to other accessible income to pay at my personal tax rate. So we can see from the above example that instead of having the pure capital loss, you get 50% discount of your personal tax rate on the basis of the capital loss. You might think, let me sell shares at a loss at the end of the financial year to save tax and buy them back at the beginning of the following year when they might be rebounding in the long run. However, this behavior is classified as wash sale, and most countries have rules that prevent the wash sale. In 2008, the ATO issued tax ruling to prevent investors taking advantage of the capital loss event. If you do that, ATO would disallow the loss if the sole intention of the sale was to minimize tax. So when should we consider tax loss harvesting then? The first scenario is that when you have substantial capital gains in the current year and looking for ways to offset it to lower your tax burden. Like what we mentioned before, unlike the tax rules in the US, in Australia, you cannot use the capital loss to offset other source of income, but can carry forward any unused losses to offset against future capital gains. So when you plan to realize a substantial capital gains for the current year, and there are stocks that you've been wanting to get rid of, you can consider tax loss harvesting to reduce your capital gain tax. For example, you plan to realize some capital gains for cash to prepare for your retirement, or your personal marginal tax rate is relatively higher this current year. On the other hand, if you are currently sitting in a lower tax bracket, you can even implement tax gain harvesting by selling investment at a gain and then buying back the investment because there's no wash sale rule for selling for profits, as you will still be paying the capital gain tax for the gain. There's another reason that you may consider tax loss harvesting is that you want to sell some losers for better opportunities. In investing or economics as a whole, that we talk about opportunity cost a lot, that you don't want your cash to sit in a sour investment, which could be taking advantage of a stock that has a better prospect, even it means that you're selling it for a loss. By doing that, it's crucial to remove emotions from your decision making, and this is why it's not uncommon for underperforming stocks going from bad to worse in June as investors tidying up their portfolio. However, think through why you bought a stock in the first place. Has the company's fundamentals changed? Because you don't want to sell losers solely for the tax reasons. End of financial year is also a perfect time to reassess our portfolio to identify any lagging investments that can be candidates for tax loss harvesting. And periodical portfolio rebalancing and tax loss harvesting can really go hand in hand really well together. And when we look back over our portfolio, you may want to adjust your asset allocation, lifting more defensive assets, for example, or your satellite individual stock holdings are taking too much weight. And this is the time that you decide whether to bring forward the sale of particular investments to realize a gain or loss in the current financial year, or you have previous capital losses carried forward to offset capital gains for the current year. We can see from here that anything involved with taxes needs a lot of planning. There's always ways to minimize the taxes if you use different methods strategically. If you would like to get more tips on how to save taxes on stocks, here's a video that could potentially save you thousands that you don't want to miss. My name's Irene. I'll see you next time. Bye.